The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
All right, and welcome to Volatility Views, and I hope everyone out there had a great and a profitable trading week. My name is Mark Longo from theoptionsinsider.com, as well as the Options Insider Radio Network, and I am joined, as always, on the Vol Views panel here by my boon companion, indeed, the dark side to my light side, even though he disputes that comparison, good old Don Schlesinger from the Volatility Exchange. Don, welcome back to the program, sir.
Happy to be here. Looking forward to our guest today. I think he'll have some interesting things to say. And as always, we try to bring a nice variety of both academics and practitioners to the show to share their viewpoints.
Yes, I think it'll be an interesting and perhaps even a spirited discussion on the world of volatility and volatility products. And speaking of spirited discussions, and speaking of the dark side to my light side, we are also joined by one Mark Sebastian from OptionPit.com. Mr. Sebas, welcome back to the program to you as well, sir.
Hey, thanks for having me. You know, I love coming here.
You love to come on here on our Volatility Academic Roundtable where we bring in...
You know what? I as tradery as I am, I really do enjoy kind of the deeper thought side of this business, because I think that it's a really important thing to discuss. So many people think that traders are just these, oh, I'm a trader, and there's so much more to trading than the way it's presented. Let's put it that way.
Maybe we should change the name of the program to Deep Thoughts on Volatility with Mark, and Don. How about that?
I think that's an excellent name.
You might have some trademark disputes coming away, but it's worth the fight, I think.
Agreed.
All right, and with the team assembled, we're going to dive right into the Volatility Review.
It's time for the Volatility Review.
And welcome to the Volatility Review. This is, of course, a portion of the show where we look back on the week that was in terms of volatility. And what a week it was. And, of course, today as we record this, the markets are down a wee bit, about 0.5%, and the good old VIX cash is about unched on the day. But that is certainly not the case for the week. And we've been debating for quite a while what is going on here with the VIX and how low can it go. So, Mr. Sebas, I put it to you. How low can the VIX go? If this was a limbo competition, how low could the VIX go?
It can go really low. I would point out that we have we've got a VIX that's 18, but realized volatility is around in the last 10 days. Realized volatility is around 7, and even over the last 30, it's only around 15. So the VIX is overpriced right now, and I think it's a sale. So I think the VIX could get down to 16, if you ask me.
There you go. So hit all bids above 16. You heard it here first from good old
exactly
Mark
what I
Sebastian.
said.
That was literally, those were your exact words.
Mm-hmm.
We'll play back the transcript so all of our listeners can hear.
Yes.
All right. And since we do cover the broad spectrum of volatility and volatility products here on the program, we also like to dive into the world of Euro Vol and the Euro VolContracts trading over on the CME. So, Mr. Schlesinger, what was going on for the week that was in terms of Euro Vol?
Well, we actually had something that was more equity-like than currency-like. We had the euro rising. Last time we were on, we were about the 128 or 9 level. We're up to about 131. And with a rise in price often comes a drop in volatility in the equity markets, but not necessarily in the FX or currency markets. And yet that is what happened here. I had jotted down some notes from last week. When we go into the Crytsal Ball segment, we often ask for looking forward or a prediction. And I had said, let's look a little bit lower. And 1168 became 1082 on the settlement price of the front month February 1 vol contract. So we actually have realized volatility for the period now standing at about 10.5, which is, historically just a little bit on the low side. And the actual forecast volatility from our Volatility Institute friends is right about 11% even or so. So we did have that drop that we were looking for, and we'll talk a little bit more at the end of the program about levels going forward. The other thing that I wanted to mention very quickly, since we will be coming out with equity vol contracts on the Nasdaq, is that if you were to ask anybody what volatility has been in the equity markets over the past month, I'm not sure everybody would realize how very low they've been. They look at VIX and they look at 20 and 19 and 18, but that doesn't reflect at all what 1 month historical volatility has been in the equity markets. So I don't know if it would surprise some of our listeners to know that for the past 21 or 2 trading days, 1 month time, the actual or realized historical volatility of the S&P 500 was 9.83. We haven't seen levels like that in a long time. And even for Nasdaq, it was 11.02. So we had extremely low volatility over the past month. And final comment that I would make on that is if you were trading such an instrument, a realized volatility contract, and you thought, gee, that was kind of low, 9.83, must not have had much action, I would point out that at the same time the realized volatility was recording those levels, the volatility of that number, in other words, the volatility of that 1 month historical volatility, was 152. So when you think about trading options on a product such as a 1 month volatility contract, you realize that regardless of what the absolute levels of volatility may be and what the return or the payoff would be, the opportunities for trading, whether it be day trading or speculating or whatever the case may be, are absolutely phenomenal with an instrument that can display over a month period 152 volatility.
Well, we've talked about it before on the show here, and that just goes to prove the point again that those contracts certainly do deliver an interesting bang for the buck. And I can't wait till those NASDAQ contracts are listed, because then we can see the Don Schlesinger sold to you in full effect as we watch that implied vol slowly, or perhaps frighteningly quickly merge into realized vol. If it performs the same way the Euros did with that implied to realized transition, it should be an interesting first couple of trading sessions for those products. All right, so that's going to do it for our volatility review, and now we're going to dive right into our volatility viewpoint.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
And welcome to the Volatility Viewpoint. This is, of course, the portion of the program where Don and I bring on a guest an esteemed guest from the world of volatility and options trading, and then we proceed to grill them mercilessly on a variety of subjects relating to options and volatility. And today's guest is John Bilson. He is the professor of finance over at the Illinois Institute of Technology, Stuart School of Business. John, welcome to the program.
Well, thank you very much.
All right, John, I'm glad we could have you on the show. And as we are wont to do with all of our first-time guests, why don't you give our listeners a little bit of your recent background when it comes to derivatives and the derivatives markets?
Okay, so I'm the director of the finance programs at the Illinois Institute of Technology. This is a school which has many, many different academic programs devoted to financial markets, including things like mathematical finance, computational finance, management science finance. The program I run is our MS Finance program, which is one of the largest and most respected finance programs in the world. Financial Times recently ranked us 3 in the United States and 20 in the world. So that's what we do. The characteristic feature, I think, of IIT programs is the combination of technology with financial markets. We try to teach people with an engineering and computer science background how to work in our Chicago markets here.
Hey, John, how are you? Welcome
I'm
to
good.
Volatility Views. So, yeah, you know, the IIT program is really interesting. What would you say are the what differentiates IIT from a traditional MBA program or, the normal path that many a potential MBA would go on? Why does someone choose IIT over, say, a University of Michigan, which people do frequently?
Yeah. Okay. So, business schools have tended to dominate finance education, but the financial services industry is increasingly a technological industry rather than a business industry. We started our program in 1990 as a response to the 1987 academic crash, where people felt that the technology of the financial services business was not keeping up with the developments in the market. So our students do not compete with MBAs. Our students are the computer scientists, the programmers, the developers, and those sort of lower level positions. On the other hand, if you go to the Chicago Mercantile Exchange, the CEO is a graduate of IIT. We have 4 directors who are IIT graduates. So they do eventually move up to the top, but we really start people working in the guts and the back office of the exchanges.
Yeah, the programmers and the CS guys used to be the junior level guys, but they're being elevated quite a bit now to since everything is so automated and algos are becoming a larger part of the scene. That is definitely you can't be effective these days without a significant and quality CS staff behind you manning the scenes.
And even a job like a trader, a trader used to be a human being. Now, if we're training people to be traders, we're really training computer scientists to write trading algorithms. Blair Hull once said, if you're reaching for the mouse, you're already too late. And I think that describes the current state of what's happening in the markets.
That's probably a good synopsis.
I think that's an interesting synopsis, but I would actually argue that it's a little different. And tell me what you think of this analogy. I think that traders are, the programmers are really needed. And what the programmers do is actually build the aircraft.
Mm-hmm.
But traders are the pilots or the guy behind the steering wheel putting in the inputs. And they're both really important. And yet it's interesting. I have not seen a lot of guys that are great quants that could come up with the actual trade generation. And I don't know a lot of great trade generation guys that are actually incredible quants.
Mm-hmm.
What do you think causes that dynamic that happens between trader and quant, and why does not the quant trader truly quite exist yet? What do you think are the limitations to that?
Look at the most successful person during the financial crisis, which was John Paulson. he was not doing quant trading. He was the guy who sat back and said, look, what's happening in the mortgage markets is ridiculous, and I can make a lot of money betting against the mortgage markets. There's always going to be a role for a person who is doing fundamental analysis and betting his wallet on his views, right? But at the same time, our exchanges as technical mechanisms are becoming increasingly sophisticated. So what our traders are doing, I think, is you're right. We're building the plane. We're not necessarily building the pilots.
Now, John, one of the things I like about what you're doing over there at IIT is you take an interesting approach to your curriculum, including trying to fill some of the gaps in the markets with some new theoretical products that you guys create over there. I think one of the more interesting ones that you guys have cooked up of late are your absolute return contracts. Essentially, you're looking to pay the pure or absolute return on an index on a given or daily basis. Is that pretty much the synopsis of that product?
Yeah, let me explain. One of the big developments with electronic markets is we can deal in more diverse products and smaller products. So, for example, there's a foreign exchange platform called Oanda, which is now allowing people to trade foreign exchange in $1 units. You can buy 1 British pound or 1 euro or 1 Japanese yen. So we want to develop electronic products which are small and devoted to the retail sector. So a lot of the volatility is very easy, hard for the average retail investor to understand, but he understands the absolute return on the market. So if I create a contract that says, I'm going to pay you tomorrow the absolute return on the market, and the person can look up what that absolute return is, then that's going to be a very easy contract to sell to the public. You can do it for 1 day, or you could do it for a strip of a month, or you could do it for a year. From a market perspective, this product is very interesting because we can see how volatility varies on a day-to-day basis. Is volatility greater from Friday to Monday than it is from Monday to Tuesday? Is volatility greater on the day of an economic announcement or when Ben Bernanke speaks? And all these sorts of issues in high-frequency finance can be addressed through these sort of micro products. So I also think they'd be a lot of fun to trade.
John, what do you think, speaking of volatility, one of the things we debate constantly on this show is measurements of volatility and kind of the overpriced, underpriced in the option markets. And Don, who I wish, do you know Don?
Yep.
He is, Don sold to you Schlesinger. He and I are constantly going at it in terms of, what is volatility in the market and, are options overpriced? And if so, how much? What do you think are the best ways to measure volatility? And how overpriced do you think the derivative markets are?
Okay, so let's go back to the absolute return contract. We can show mathematically that this depends purely on the volatility in the market, okay? But volatility is not normally distributed. Volatility has big fat tails to the upside. So absolute return, the worst thing can happen is the market is unchanged. The best thing that can happen is the market goes up or down by 20%. So using sort of standards like normal distributions is a very inappropriate way to value these contracts. What we do is we create a market in which the various volatility forecasts trade against each other, okay? And then we see which one makes money and which one loses money. Now, the advantage of that is if you have one bad forecast and everybody else is right, the bad forecasts will all go against the good forecasts will all go against the one bad forecast and drive it from the market. So we can find out very quickly who has a good forecast and who has a bad forecast. Well, one of the interesting things we've found from this is that if you put the VIX in as a forecast on a daily return contract, that the VIX is the best forecast, compared to the standard Garch and other volatility forecast models we have. So that doesn't appear to be the case that volatility is necessarily overpriced in the options markets.
And John, are you finding that across all time periods or just for the dailies?
we are doing it just for the daily absolute return contracts.
So you see, that doesn't surprise me a great deal, because it's often been argued that for overnight forecasts of volatility, implieds can do somewhat of a stronger and better job than as you take them out for longer periods of time. And the actual level of volatility and how it applies to the price of an option in terms of one day, as you well know, the Vega or the Kappa, the sensitivity to changes in forecast for volatility for a single 24-hour period, while they're still there, they're not terribly dramatic. And so when people talk about these risk premiums and the differences between implieds and realized, I would imagine that, over longer periods of time, the efficacy of implied volatility as a forecast for what realized will be would start to wane rather dramatically.
Yeah, I think if you're holding an option for a year, that maybe there's some evidence. If you go down to the garage at the CBOE and you look at the Ferraris are typically not held by the customers, they're held by the members of the CBOE. And the members are typically short options and the customers are typically long options, which suggests to us that maybe volatility is overpriced in the long term. But if you take a retail customer and tell him on that basis that he wants to be short volatility, he's likely to be broke before he gets to realize that long-term overpricing.
Well, you certainly need deep pockets for any of those kinds of trades, and it's always the question as to whether or not the catastrophic event happens sooner rather than later, and how much of a war chest you can build up on the short side before something goes wrong. And when it does, the question is, do you have enough to withstand that, or has it, overflowed the banks?
Right. But, the advantage, I'm getting back to this absolute return stuff, the advantage is really this is an option with a changing strike. The strike changes every day to be the closing price today. But
yeah,
you
so
can
it's
still trade.
It's a one-day at-the-money straddle, basically.
Exactly. But you can buy this thing 3 months in advance, or you can buy it for a year. And you don't know what the strike's going to be. You just know at the end of the day it's going to be an at-the-money straddle.
So so if you do it in advance and not night by night, then it's like a delayed strike.
Mm-hmm.
But otherwise,
and these are the sorts of trades that these electronic exchanges like the VolX really should be creating, because it's the sort of thing I think that's attractive to the internet retail trader. And it's a good product that, the market makers can hedge pretty easily with something like a VIX index.
Yeah, well, it's interesting that you mention that, because we've been bandying around with the advent of the weekly options that were introduced not all that long ago, and how popular they've become. We've been discussing a bit, and perhaps we should talk to you a little bit about the modeling of vol contracts, not necessarily for longer durations, but perhaps looking the other way for shorter durations. And I think one of the problems that we run into, whereas you can always do a calculation of standard deviation of a return and a log return, night by night if you want, the classic wisdom is that in order to get a meaningful kind of standard deviation, you usually require about 20 data points in order to say that you've got any confidence in the calculation. So the idea of creating a contract that's going to deliver the realized volatility as opposed to a return. You can do a return because that's a price-driven thing. If we want to deliver a contract that's going to give the owner or the seller the realized volatility over the period, and we define that as a single day, Well, there's a little bit of a problem with that in terms of the calculation and the number of
Right.
data points involved.
Exactly, because the volatility calculation's based upon the square of the return. And on a one-day basis, the square of the return is a very scary number. But if you work on the absolute return, it's not that scary. It's just like the market. On average day, it's around 50 basis points. Bad day, it's up or down 1%. So I could have a contract which is $100,000 times the absolute return, and I would pay $500 for that contract today. And tomorrow I'd get the absolute return times $100,000. $500 was based upon an assumed volatility of 0.5% per day.
This would be kind of an interesting trade against like an expiring option portalio.
Mm-hmm.
Guys, I lost my connection there for a couple of moments. I missed John's answer to talking about the one-day period. I apologize, but if we could just ask him to repeat that, because I'd like to hear what he said.
Okay, so what I was saying is the volatility contracts are based upon the standard deviation, which is related to the variance, which is based upon the square of the rate of return. Now, the square of the rate of return is a very scary number on a one-day basis, because if we have a 4% move, that goes up to 16, and those extreme observations are very difficult to price. The absolute return is not anywhere near as scary, okay? So let's say we have a 0.5% expected absolute return on a $100,000 contract. The retail investor pays $500 today, and he gets the absolute return times $100,000 tomorrow.
Yep.
Well, that's a number he can look up in the newspaper. He can see it on CNN. He's got a very clear idea of what his payoff's going to be. As far as the market makers are concerned, they can hedge a book of these absolute return contracts pretty easily with positions in something like a VIX contract. In the old days, we'd never do a contract like that because the paperwork was too difficult. But now with electronic trading, we can trade these sorts of contracts, and really it's no different than daily mark-to-market on any other position.
Yeah, and Don, my thought was this would be a really interesting product against a grouping of like expiring options, or like this would be a fun little contract to trade on expiration Friday or on expiration of weeklies as kind of a straddle versus this total return trade. Bet you there'd be something there, don't you think?
I think it certainly opens up the realm of doing one against the other. But in trying to see what the pricing would be, and John, of course, has worked on this already. This concept of a one-day straddle, and whatever the pricing is, if you're holding it, and we're going to talk about the next product, John, which I'm interested in also, and that is the kind of like crash protection. So, if you're holding this on a daily basis, you're basically buying repeated one-day straddles, basically,
right,
that expire in 24 hours. And maybe if you do it on Friday, you get the weekend. So, there's a little bit more to it than a single day. But obviously, when you price options, it's a square root function over time rather than linear. And so if you price 4 quarterly straddles, they're more expensive than a single 1-year straddle. And so doing strips of these one-day consecutive straddles, waiting, for your ship to come in with a big return, I imagine cumulatively could become very expensive to do them if you're the buyer on a daily basis.
But I pay my $500 today, and I get some payoff on the contract tomorrow. I know I'm going to get some of it back, right?
Well, yes, unless you're exactly unchanged, right?
If it's unchanged, I get zero. That's not too bad, right?
Right.
And the advantage of this scheme compared to, say, the volatility contracts is this then provides a market which gives us a market estimate of volatility for every day into the future. So we can examine weekend effects, announcement effects, earnings effects if this was on individual stocks. It would be a very, very interesting set of information for us academics to study.
I think it's an interesting approach you bring up, too, because there is a need these days for that sort of entry point option vehicle for that online retail audience. I mean, this is essentially replicating an at-the-money daily straddle would be probably a significant hurdle for your typical novice options trader to try to do on his own, let alone being destroyed by the time decay every day. It would be a disaster. But something like that where this contract does most of the heavy lifting for them and just kind of prints out the return, here you go. That is something that I think that could be easily done. When we've talked on this show a number of times and many of our other programs about how difficult it is for retail to effectively trade long premium without being nickel and dime to death by decay, that this kind of product could take some of that risk off the table for them.
And it removes all the need to explain options. It's just a contract that depends on the absolute return. It's like a futures contract far more than an option contract.
John, we had a guest on a while back. In fact, Bob Kraus and Mark Sebastian interviewed him while they were out in Las Vegas at their conference. And that was from the NADEX, the North American Derivatives Exchange, that have these binary options. And there may be a similarity here between what you're discussing and the ability to buy a contract that settles at 0 or 100, and based on a particular strike that you would be attempting to reach, to touch it or not touch it. The difference, of course, is that your return gives you not just the binary, but gives you the actual price that you have realized in one direction or another. But there's a sense of volatility and probability playing into this one day on their type of product as well.
Right. But the most important thing is the retail investor who is sitting at home on his computer looking at CNN. What information does that person see every day? What he sees is the return on the market, right?
Yes.
And so he doesn't see the binary return. He doesn't understand that. He doesn't understand what an option is, but he understands what the return on the market is. This is the most widely publicized piece of information, is the return on the market from the previous day. So that's why we think this would be a popular contract to trade. All of your publicity is done for you.
Here's the next question. How do you draw on the institutional crowd on this type of product?
Well, I think the institutional crowd might get interested in arbitraging between this index and something like the VIX futures and other option products. But for the institutional crowd, I think it's the information which is revealed about the future times profile of volatility.
Yeah, no, I understand that. But is there an institutional customer that would want to use this product, do you think?
I think, if we look at some of these retail foreign exchange platforms, which is the other thing I've been working on, they are created for the retail customer, but they're attracting more and more big institutional clients. Again, you should have Michael Stum on from the Oanda platform, which is the best retail FX trading platform, and see that they're not only attracting a huge number of retail clients, they're attracting a large number of institutional clients as well.
Now, John, we've had an ongoing discussion on this program with many of our guests going back a few weeks now about tail risk in the market and whether it is indeed properly priced or underpriced or overpriced. And I can't let you go today without bringing up one of your other products, which I think will be very interesting to our listeners, which are, of course, your crash option contracts. So why don't you give us a quick overview of those products as well?
Okay, so the crash option contract is a similar thing to the absolute return contract, but it pays off when the market falls by more than 1% in a day. So if the market falls by more than 1%, you get the difference between that 1% and the closing return on the market. Now, because we take out a lot of the daily changes, the crash options are a lot cheaper than the absolute return options. But they're an ideal mechanism for somebody who is, say, concerned that there's going to be some disaster happening, some big stock market crash. Okay? So you could buy a year's worth of these sort of options. I think the last time we priced them, it's something like 3 to 5% of the value of your portfolio, and you could be protected against a crash in the market in any one day. I think that would be a very exciting product too.
Now, the absolute return product, I can definitely see the clear use case for, because you're right, it is a very widely disseminated number, and most people aren't going to go out and replicate the daily ATM straddle for themselves on an ongoing basis. That's an onerous process, to say the least. But these products they're obviously very clearly linked to an out-of-the-money put in, let's say, the SPX. And so someone who's a little more, who's sophisticated enough to know about the risk of crash protection or the need for crash protection would be also looking at the out-of-the-money put. So essentially, are you saying here this is pretty much just a value proposition? Obviously, you're not getting the exact same payoff characteristic, but you're saying you can get the extreme end of the protection for a fraction of the cost?
Yeah. Let's say I'm a retail equity broker and I'm talking to a client. The client says, I've got my retirement portfolio. I'd like to put more in the market, but I'm really scared about these crashes and what's happening in Europe and things like that. Okay? Then I could go to that client and say, well, look, we could offer you a product which is fairly priced. It's actually got an expected cost of 0, but it's got to put an upfront premium of around 3 to 5%, and this will protect you against any one-day move in the market. It's not going to protect you against a market that goes down continuously for 3 months, but it's a protection against these extreme events. There's a similar product in the electricity markets where we worry about plant breakdowns. Normally, electricity prices are $35 to $100 a megawatt hour. If you get a plant breakdown, it's $10,000 a megawatt hour. How can we separate out those two? We do it with a crash option. But in this case, the crash applies to a plant breakdown rather than a market event.
Maybe I can give you a chance to weigh in then on our ongoing debate we've been having on this show recently as well. Most of us here on the show, most of us hosts anyway, feel that tail risk is, if anything, overpriced in some of these downside put options in the marketplace these days. We had a guest a few weeks ago who took the other end of that spectrum and said he thought for those extreme events, the quote-unquote black swan events, tail risk was actually underpriced in the out-of-the-money puts in the S&P. But that, of course, raises the question of what do you do the other 364 days a year when the market is not imploding, and are those levels fairly priced or not? So given you're someone who's created a crash option contract, you obviously think there's a need to fill here. What do you think about the current levels of tail risk being priced into the market? Are they fairly priced, overpriced, underpriced?
Well, just think of it from the perspective of a market maker in this option where you're the guy that's selling these options. Clearly, this is a hugely risky activity, right? You're collecting a small premium every day, but you're laying yourself open to a catastrophic event at some stage in the future. Okay? It's far more like an insurance product than it is like an exchange-traded product. So it's clear that we should have a risk premium on these products. If they were fairly priced, wouldn't everybody want to be long a crash option? Simply because most of us are long in our stock portfolios?
You'd think they would fall out that way.
So
yeah.
I would think this thing would be trading at a premium, but it's offering a valuable service to the investor by allowing them to sleep at night.
So we all agree to that, John, and the only question is whether or not these options have settled in at premiums right now that are consistent with the probability of that catastrophic event and price it fairly, or whether or not it may actually be possible that they even understate that probability.
Mm-hmm. Well, this sort of comes back to a totally different discussion, which is why do options smile? Why do we have these volatility surfaces and all that sort of stuff? My interpretation of the smile is that it reflects the ATM volatility as the market moves. So if the market fell 10%, volatility is going to be a lot higher because the market reacts far more to down moves than it does to up moves. And that's really what the volatility smile is reflecting.
I don't know about that. I think volatility smile is a customer cause based on the macro situation. Otherwise, you wouldn't have volatility smile the opposite way in oil or in some of the other things.
The difference between oil. Let me just say the difference between oil and stocks. Most people are long stocks, and most people are buying oil, so they're hurt by higher prices.
Exactly.
So when the price goes up, implied volatility goes up in oil. But in both markets, if you want to explain the smile, you look at the covariance between the return in the market and the change in the ATM implied volatility.
I think it's completely caused by the fact that you have the hedging customer buying puts. Why are calls cheaper? Because the whole world is collared. Mm-hmm. If you go, if you're CalPERS, it's evil for you to short stock. Everybody's 401k is holding stock. Everybody's, everything in the world is holding stock. And so because of the natural inclination of the customer, that causes supply and demand differential. I don't think it actually has anything to do with the fact that puts are expensive because volatility is going to be higher if we drop. Puts are more expensive because people are buying puts because everybody is long.
Okay, well, I've actually got an academic paper on this called The Shadow of the Smile, which explains the smile characteristics of the volatility surface in terms of a model which relates changes in volatility, ATM volatility, to changes in the market.
Well,
and it works pretty well.
I agree with you, but I actually think volatility smile is completely caused by psychological trading.
Well, that's an awful thing to say.
Well, no, it's the natural.
That's like the CBOE saying it's the index of fear, which is also a ridiculous thing to say.
No. Well, agreed. But the natural inclination of the whole world to be long, the fact that the whole world is long, creates a supply where they buy puts and sell calls to pay for it. That is absolutely why.
But at the same time, we have a group of people who make a lot of money in Chicago and other places by being the arbitrageurs, efficient market people who ensure that these markets reflect reality rather than the psychological problems of the interior retail investor.
But you still can't fight supply and demand issues.
Sure
why?
You can.
Why is a Louis Vuitton purse more expensive than a Coach purse?
Because they're not traded in futures markets.
No, because demand. You are completely throwing out the fact that there is that market makers can try and keep markets as efficient as they want. If you sit there and you say, you know what, I am right, and Goldman and major players are buying SPX puts. Now you may win the war, but you will absolutely be crushed by the battle and out of business.
Definitely.
Right? Yeah. So what you're saying may be right on some sort of academic level, but in reality, volatility curve and smile is completely created by supply and demand. And the fact that there is massive demand for puts because people are need to hedge their downside. Hedgers cause skew. That is it.
I like this. I think we could have John back for an interesting discussion on the root cause of academics, because Mark, obviously you and I come from the same background, the market making background. We've seen the influence of paper flow firsthand, and I see where John's coming from as well, because in the near term moves up and down around the at the money. Sure, that's going to be the predicted movement of where the at the money is going to go. But once you get into those extremes, the upside with the calls, the downside with the puts, it is. At least I tend to agree with you. It is completely driven by paper flow.
Let's go through the various markets. Equities trade at a positive skew. Energies trade a different way. Interest rates and currencies tend to be pretty symmetric. why are there these differences across the markets? Well, one explanation is this reflects the correlation between the market move and the implied volatility. And you know that when the stock market falls, the volatility goes up. That's one of the most widely understood empirical findings. The other thing we know is, when did volatility start to smile? It started to smile after the 87 crash, when the volatility at the CME went up to, I think it was 187% on that day of the crash.
John,
before that, there were still orders, but the volatility didn't smile.
It actually started to skew and be asymmetric, which I'm sure is the point that you're making, but just to get the terminology. There was a slight smile prior to 87, which was an upturn for extreme out-of-the-money calls and puts symmetrically. And that became called the smile because it looked like somebody was smiling.
Right.
And then I used to say that after the crash, the smile was wiped off the face of options forever, apparently, because you now have that asymmetric skew, or the smirk, or whatever you want to call. So I know, of course, that you understand that, but just clarifying the point for listeners that I kind of don't like to call it the smile anymore, because that symmetrical smile is kind of been gone for 25 years.
Yeah, and traders will tell you that, I wasn't around in 1987. I mean, I was 9, but traders will tell you that smile was around, before the crash, like Don said. And, one of the things I would say in each of those markets that you just brought up, the reason why that skew exists is because of the customer. All right. You're right. Oil, people are afraid of it going up. So guess what? Airlines, industrials, they buy calls to manage their risk. All right. And CalPERS buys puts to manage their risk. That the fact that somebody that has huge pockets doesn't mind giving up a little bit of risk premium to make sure that they don't blow up and lose everybody's pension. All right. With gold, why is gold have kind of that a real smile like Don would talk about? Well, you've got two fighting sides. You've got the side that sees gold as an industrial or as a product, and then you've got a side that sees it as an investment. So that creates the kind of dual smile.
Yeah, Mark, I don't think we disagree on this, but we have to agree on the interpretation of this.
Yes, that's
exactly
correct.
That volatility is caused by activity. Okay? The reason why when the equity markets fall, volatility goes up is because volume goes up, right? And people are scared. When the market rises, do people go in and try to liquidate their portfolio or do stuff? No, they don't. So I think you're right in that it reflects the customer, but it reflects the customer through the customer's effect on at-the-money implied volatility.
Yeah, look, the smile itself is caused by the fact when the market is rising, customers are putting on risk reversals and collaring. Like look at the most classic example. One of the richest guys we all love, owner of the Dallas Mavericks, Mark Cuban, made all of his money by collaring Yahoo. I don't know if you knew that. I'm sure you.
No, I didn't know that.
Yeah, he is the classic example of a guy that collared. And so the reason why, and why does skew actually flattens when volatility increases? All right, why? Well, in low vol environments and rising markets, you have a massive push toward buy writing and collaring, and that creates the heavy skew. All right, in a high vol market, yes, volatility increases at the money, but what you'll see is the curve actually flattens up. All right, because hedges are working, and you don't see that same demand for that way out of the money. The demand actually moves to at the money. So it's you're right in that I think you give customers too much credit. is what it comes down to.
I don't give customers too much credit. The customers don't determine the prices. Goldman Sachs determines the prices. And we can't give them too much credit.
No. See, that's where I think you've got the major difference. Goldman Sachs creates the price in reaction to the customer. Customer demand creates the price.
Mm-hmm. John.
All right. That's the major thing.
We could discuss this for a long time, and
we could go on with this one forever.
I've actually tried to stay out of it because I have, really strong opinions about the whole thing, but I don't want to take all the time on it. I have a follow-up question to the crash options, and then I know you have a meeting that you have to run to, so we're going to let you go. But I wanted a clarification on something. If these 1% out of the money puts, basically, what it would amount to on a daily basis, are going to supply any return beyond a 1% downward move on a daily basis, it then would seem to me that you're guaranteeing this day by day, as if over a year's period. You're not owning a yearly put, you're owning a strip of such daily 99% puts, if I've understood correctly.
Right, exactly. So the difference between these contracts and regular options is the strike price changes every day to the closing price.
But right? what I don't see then, John, is anywhere near on an annual basis this 3 to 5% that you mentioned, and that's the part that puzzles me, because we spoke a little before the show, and I tried to price a 1% or 99% put for a single day, and giving it, say, a 20% implied volatility. And unless I did something wrong, it looked like it was going to cost about 0.1% for that daily option.
Right.
Well, if I reset it every single day and I have to buy 252 of them in order to reset that protection each day, it sounds to me that if I buy a year's worth of these things, it's going to cost me more like about 25%. I don't see how 3 or 5% would.
Yeah, I don't have the numbers in front of me to calculate that, but that's certainly a number we could look at. I think what's happening is maybe when we look at the 3 to 5%, I'm looking at the payoffs on the options over that period too. So if you've got to go through and look at. I think what we are doing is we are taking the VIX as a measure of the implied volatility, using that to price the option, and then looking at the number of times we've got a payoff on the option to calculate out the cost, including those payoffs. But I really don't have those numbers in front of me, so we could leave that for another discussion, really.
Okay, fair
if you like, what we're trying to do today is introduce the concept. If you like the concept, then we can work on the details of what it's going to cost and how to do it on the exchange.
Sure.
Okay?
John, thank you very much for joining us today.
I really enjoyed talking with you. You're a great guy, and I appreciate you letting me challenge you a little bit. So
that's fine.
We like to put our guests through the ringer a little bit here. It makes the show very lively. Fun. But before you go, I do want to give you a chance to let our listeners know about anything interesting you have coming up over at IIT, papers, publications, events, what have you, that might interest our audience.
Well, I think what we're doing is we're creating a wonderful new environment at IIT. Next year, we're moving down to our main campus at 34th and State, which is right opposite Sox Park. And we're creating some new programs which are going to be university-wide programs, including computer science, mathematics, electrical engineering, business, finance, all of these things. So we're making a university-wide commitment to creating programs for the Chicago financial markets. And any of your listeners that want to hear about that should get on our website at stuart.iit.edu. Or get in touch with me and I'll tell them about it, okay?
All right, John, great. Thank you very much for coming on the program, and maybe we'll have to bring you back down again so we can dive into some more of these products you're creating over there and some of the details about them.
Yeah, sounds like a lot of fun.
Great, thank you. And that's going to do it for our Volatility Viewpoint segment. And now we're going to roll right into our Crytsal Ball segment.
And now we take a look at the Crytsal Ball.
And welcome to the Crytsal Ball. This is, of course, the portion of the show where we dive and peer into the murky ether of the future and attempt to divine what the world holds in store for volatility. And we'll kick things off with good old Mark Sebastian from OptionPit.com. And I have a feeling, Mr. Sebastian, given what you said in the opening of the show, that you're going to say, buy all VIX products, buy VIX Premium, buy VIX Upside with both hands. That's what you're going to say?
Yeah. No, I don't think so. No, the absolute best thing you can do right now, if you're actually worried, one of the interesting things going on, this is more of an option block thing, but there are some really good opportunities to buy individual stock name options that are cheap, if that makes sense. So what do I mean by that?
That doesn't. What are these individual stock names that you speak of?
Apple is at the lowest level, is at the lowest implied volatility level that I can find on record. It was trading $10 the last time it was this cheap to buy option premiums in Apple. So what I like is a portfolio of selling premium in the big indexes, in VIX, and finding these super cheaply priced individual equities that are worth buying. If you insist on buying insurance premium, do me one major favor. Sell VIX, buy SPX. Do not buy the VIX contract. It is crazily overpriced.
Mark, here's the question just quickly for you. When you're looking at Apple volatility and saying it's so low, are you suggesting a directional trade because you like Apple, or would you really be saying buy these single name straddles with their low volatility and sell the higher implieds of the various indexes that you mentioned?
The latter, actually. Okay. Most retail traders are typically out selling premium if they're trading options, at least the sophisticated ones. And, they need these type of opportunities to hedge. And Apple is presenting us a wonderful chance to hedge. And so one of the things I would point people toward, if you're directional, it still makes sense to buy a strangle. One thing that's kind of interesting is the May, somewhere in May ahead of earnings. I think that could be a really interesting trade.
Right.
So there's a real good opportunity. And if you like Apple stock, for instance, the options are the better trade. All right. You can buy a May at the money call. And if Apple goes up, even with the premium you're paying, you probably will end up making more money on a near-term move because the vol's so low. There's just some real opportunities in some of these individual names out of earnings where it's almost like it's been buy righted to death. Does that make sense?
Yeah,
it's almost like Apple's going through buy right Monday.
People with all of the Greeks, people don't often talk about another measure that you just actually discussed without naming, and that was this kind of leverage effect. And there is a letter for it. It's the lambda for leverage with an L. And it's, if the stock price were to move 5%, how much would the option price move? And you might find that it's 50%, so that you got 10-to-1 leverage. And therefore, when implieds are low like this, and you nonetheless do get a decent move in the underlying stock, the leverage can be enormous through the options markets. And I think that's what you're pointing out.
Yes, absolutely. And, it's unbelievable. I mean, when I saw what was going on in Apple, I was just shocked. The earnings month is trading, you could get an at-the-money option in the earnings month at around 21%, which for Apple is insanely cheap. So there's some real opportunities in some of this kind of, for the retail public to take advantage of low vols. And, Yeah, Don. Lambda. I was actually in Lambda. They made a movie about me in the 80s. I don't know if you knew that.
All right. Mr. Schlesinger, what is going on, or what do you see in your crystal ball for the realm of the Euro Vol, sir?
Well, this may be one of those weeks where I kind of chicken out and take a pass, because we've now returned to levels in the high tens that historically kind of look about right. And whether I check the Volatility Institute forecasts or take a look at the actual partial volatility that's been logged in the contract so far, they all are lining up rather well at this point. So tough at the moment to make a call, as at least on a weekly basis, as to what direction we would be going on. These levels look about right.
So you heard it here from Don Schlesinger, from the cat's mouth, as it were, that these levels look about right. So stay the course until next week is the prediction here from the Vol Views show. And that's going to do it for this Crystal Ball segment. That's also going to do it for this episode of Volatility Views. Of course, I want to thank our guest, Professor John Bilson from the IIT Stuart School of Business. And by all means, if you want to learn more about what they're up to over there at the Stuart School of Business, then surf on over stuart.iit.edu for more information on their research and their programs and the events going on over there at IIT. And I also want to thank good old Mr. Sebas, Mark Sebastian, for joining us on the program today. It was a spirited conversation, but a fun one nonetheless.
It was indeed, and very rarely do I get... I swear, I'm a nice guy. I just get very passionate about these options. It was really interesting. I was talking to, I was at dinner last night with a friend, and I was just kind of talking, and the guy stopped and goes, Mark, you really love options. And I said, yeah, I think I do. And then my wife said, no, he just really loves money.
Well, it's difficult.
I do love options. I love options. I do.
It's difficult, especially you and I, who have come from the market making side. It has been beaten into us time and again, the impact of paper flow. So to hear someone discounting that in some way, shape, or form, when we have learned so many hard and painful lessons to the contrary, costing us our own money quite frequently,
I know.
that it is difficult to sit idly by and hear someone else give the typical sentiment discussions.
We should put him on a badge and let him trade with his own money and see how it goes.
Most academics prefer to remain in the mist surrounding, and then they can speak from on high in that sense. But he made some very good points, and he did. He does come from the world of which the sentiment definition of skew, which of course exists, and of course is there. I think you and I just believe that it is trumped, particularly in the extremities of the put and call wings, by paper flow.
Well, no, there's the model, and then there's the public order flow effect on the model, and the skew is created by the model trying to make up for public order flow. That's just the way it comes. That's just the way it is. And that's that.
The puts are that expensive because someone is willing to buy them. Therefore, they are that expensive.
Exactly. Exactly.
But Mr. Sebas, what else is going on in the land of Option Pit that may interest and or intrigue our listeners?
Well, I'm going to be on Tasty Trade on the 1st of February. I'll also be on Fox Business that afternoon. We've got an event coming out on February 15th using options to trade stock earnings. And aside from that, if you enjoy kind of this type of stuff and you're interested in options, you should strongly consider taking our Option Pit Silver course. So it's a pretty neat little course. Really gets into synthetics. It's kind of designed around what we had to learn when we were coming to college, and I think every trader can get something out of it, and especially the newbies.
Now, speaking of coming out of college, something we didn't have time to get to with John, but I think might be good if we bring him on again down the road, is just to discuss the general nature of derivatives education, particularly in the undergraduate level where it's pretty much almost non-existent. You really have to take some specialized coursework to even get into this kind of thing unless you stumble onto it on the floor. But yeah, it's a very difficult field to get into if you're kind of remotely curious. But yeah, and you should also, when you're doing that silver course, you should make the promo code sold to you so that you know exactly where these people are coming from who are taking the course. All right. And of course, Mr. Schlesinger, what is coming up in the land of Volex.us that may interest and or intrigue our listeners, aside from the elephant in the room, which is, of course, the impending arrival of the Nasdaq contracts?
Well, that's where all our energy is really focused right now. And of course, the agreement is completed with Nasdaq. The next step, of course, as everybody knows, when you're trying to bring out a product, is to do everything that you can prior to the launch date to do yeoman's work in guaranteeing the success of that contract. And so to that end, especially these last couple of weeks, both Charlie and Bob have been out in Chicago speaking to prospective market makers and order flow providers, because you want to hit the ground running and you want to make sure that when the product is offered, we've got the support of the market makers and perhaps several of them, and we've got the paper flow that we've just talked about as being so critical and so important. So that's where our efforts are at this moment, and as quickly as
John,
we can into place, we're going to be up and running.
I think the contract's going to be a huge success if the spread that Charlie has in series is any measure, because I mean, that guy, I mean, it was funny. You'd see Bob at a little at one of the desks having a cup of coffee, and just at a little 2-person booth. Then you've got Charlie spread out over a 6-person table, all to himself. He's like yakking it up, doing his thing. It's unbelievable. But no, I think that this Nasdaq product is going to be an incredible success, and I'm really excited that you guys are rolling out, and looking forward to working with it and helping the retail audience take advantage of something that I think is needed. You know, this type of contract is something that was only available to, the hedgiest of hedge funds and in major OTC markets, and it's great that these are coming to a more transparent and liquid market, and hopefully liquid market. And I think they're going to be a huge success, Don.
Well,
just
thanks.
like you.
Looking forward to it.
They're going to be like the Egg McMuffin of contracts.
There you go. And with those words of encouragement and indeed brotherly love, we're going to close out this episode of Volatility Views. I, of course, want to thank everyone out there for downloading and streaming and subscribing to the program and making it such a success. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about VolContracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments, and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.